like I said, we're going to talk about inflation today. Certainly a hot topic with everything that's been going on in the markets and just the overall economy. I know this is something that didn't get a lot of attention for a long time, and now it's certainly rearing its ugly head. So it's worthwhile to talk about, and we want to kind of give some pointers on what you can do to protect yourself in retirement when you're dealing with inflation. First of all, of course, our disclaimers. This information, opinions are subject to change without notice. Any type of investing involves risk, including loss of principal. There are no guarantees. This is not meant to be individual investment advice. So if you do need to make investment decisions, please consult with your financial advisor. So we'll get into it. Our great president, Ronald Reagan, called inflation the silent killer. He said it's as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. Remember when Ronald Reagan came into office too in the early 80s? We're just coming out of the high inflationary period of the late 70s, where we had an energy crisis, I guess is what we'll call it, where energy prices were pretty high. Very familiar to today, and there was a stagflationary environment. So President Reagan was very well in tune with what was going on at the time and how big of an issue it was for the American public. And if you think about it as being a silent killer, it certainly is, especially for retirees. If I would have asked most people a year or two ago what their biggest concern in retirement was, I think most people would have said something along the lines of a stock market crash or pullback, maybe low interest rates. Not a lot of people would have said inflation, and we notice this too when we sit down and talk to families. Is we're talking about the risks to their retirement and what they're concerned about. They list things out, and they'll mention taxes, for example, stock market volatility, but inflation doesn't always come up, but it certainly is more and more now, and we want to make sure everyone's aware and what impact it will have on your retirement. So if we look at risks in retirement, and this isn't all, but there's things that you can control, how much money you're going to spend. You can mitigate part of the stock market risk. Obviously, you can't mitigate all of it, but you can at least reduce your risk and not take on unnecessary risk. There's things you cannot control, which would be unanticipated expenses, healthcare being a chief one there. Obviously, inflation's the big one, and that's what we're focused on today. And then there's some things that you can kind of control that are in the middle. Taxes paid, you cannot control the tax rates, but there is some control over when you're taxed, and especially withdrawing money out of a qualified plan such as an IRA or 401k, as well as your longevity and how long you live, which inflation goes hand in hand with longevity. Obviously, the longer you live and the higher inflation there is, the more income you're going to need. So let's start and just talk about what inflation is. And inflation is just it gets kind of there's a bad connotation that goes with it. It's a bad word almost. People don't like inflation, but some inflation's good. Inflation just means that there's a general rise in prices. Here on this slide, I'm just showing there's a stamp from 2002. Greetings from the great state of Minnesota. It was 34 cents 20 years ago. So today, they don't even show prices on stamps anymore because they know that they raise prices so frequently. But today, a stamp costs 59 cents. And so that's an example of inflation. Something that was 34 cents 20 years ago is now 59 cents today. So it's a rise in prices. And like I said, not all inflation's bad. If there's a little bit of inflation, it means the economy is growing at a steady pace. It's when there gets to be a lot of inflation, especially where consumers cannot keep up. That's where it starts to cause problems and really can be a real burden on economic growth, or certainly a headwind. The classical definition of inflation, and this is more textbook, is it's just too many dollars chasing too few goods. And if you think about it, there's certainly some supply and demand. So if you're going to the store to buy something, and there's some goods there, and you just pay the price, don't think much of it. But if you're a shopkeeper, you run a store and you notice that people are paying a price and you're selling out of it quickly, you think, well, why don't I just raise the price a little bit? I could make a little more profit and do that. If it doesn't hurt, and people are still willing to pay that, then the price has gone up, and that certainly is inflation. And the thing about inflation is it's very sticky, meaning that when the price goes up, it's probably not going to go back down. Now, for some commodity prices, it does bounce around a bit, but for the goods and services that you and I pay for on a regular basis, once the price goes up, it's pretty much stuck there, and not likely to go back down. There's really two major causes of inflation. One being what we call cost push. This is getting into some economics 101. Cost push, and that's just simply an increase in input costs. We're looking at higher energy prices now. Gas prices here in Minnesota are up over $4 a gallon. I guess in California they're over 6. I think I saw. I don't know how accurate that is. And if you think about it, all the goods that we buy for the most part have to be transported. So energy is a very large cost input to pretty much everything that we deal with. Um, then there's other commodities. Down here's a little chart. This happens to be wheat, but metals, all commodities have come up in prices quite a bit recently. Especially you can see the spike here with geopolitical events in Eastern Europe, Ukraine, Russia. Ukraine is a large producer of wheat, especially for the Middle East, Eastern Europe, Northern Africa. So that's why we've seen those prices. There was a lot of talk a couple of years ago about lumber prices going up. So obviously the cost of homes went up. Then another example here is wage inflation. We see starting wages coming in at $15, $16 an hour, which is crazy. I'm not saying it's not deserved. Obviously these people work hard and deserve to be paid for it. But I remember, I'm not that old. I'm kind of in denial. I am getting old now. I remember when I was working jobs in the summer, I was getting, pretty happy to be getting $4 an hour. And I know my daughter who's working this summer, that's a similar type job than what I had, and she's making almost 4 times that for the same amount of work. So there's a lot of wage inflation. We've really seen that bump up, and obviously that's an input cost. If you own a business, you have to pay your wages. So the way that you recoup that is you raise your prices, causing more inflation. Another cause of inflation is what we call demand pull inflation, and that's when demand is greater than supply. So the examples here, there's a lot of talk of the car market. You drive by car dealerships and there's just no cars there. And what happened with the supply chain constraints, their cars were unable to be delivered. They still are backed up, but a lot of it goes back to transportation as well as the microchips used. And without cars, so people need cars from time to time, whether they're out, getting in accidents, playing bumper cars or whatever, or cars just get old and break down. They need new cars, and there's a lot of demand, and the supply is not able to keep up. And the same thing's happening in the real estate market. There's a lot of people if you look at the demographics, a lot of millennials, for example, are moving on, buying their first homes or maybe the second homes. And there's a lot of demand for the homes. Multiple stories of people coming in, putting their house on the market within hours, receiving multiple bids at or above the asking price. So that's pushing prices up as well. And then lastly, and I didn't work with my